is Mark Richardson. I used to be an organic synthetic chemist. Prior to my stint in Web3, I was a research scientist for the Australian government. I made the transition into cryptocurrency and Web3 blockchain in 2020 during the pandemic, I think as a lot of professionals ended up doing. And originally just as a researcher for Bancor, then the head of research, and then product architect, and now the project lead.
So Jake Ostrovskis here from Wintermute. My early career I spent working on the buy side in the macro hedge funds, always as a trader. I joined Wintermute to help build out the OTC desk, so now run that part of the business. For those of you who don't know who we are, we're one of the, I guess, largest market makers in the space, and we trade on pretty much every asset under the sun on a proprietary basis. So yeah, good to be here.
Hi everyone, my name is Eva Lawrence. I'm the head of EMEA for Figment. We are the largest independent staking provider globally with over 18 billion in AUS across over 1,000 clients. My background is traditional finance. I ran flow trading for securities lending at Morgan Stanley. And before that was a UK qualified lawyer, and then came into crypto around 7.5 years ago.
Thank you.
Hi everyone, I'm Dominic Dyett. I worked for 7 years at Goldman Sachs in M&A and equity capital markets, then worked in corporate development with Ripple, who's acquiring a lot of places right now. And now I work in Areta, assisting with a larger range of firms in M&A, in token issuance, in capital raises, and in market making.
Excellent, thank you very much. Right, am I okay to kick straight off? You all ready to answer some questions? So, staking and restaking are increasingly described as the next institutional grade yield market. The financialization of consensus, are we truly at the point yet or still early in building the foundations for a new asset class?
I can take this one because
yes.
I feel quite strongly about it, as Jake knows. We are building a new area of an asset class, but we are not creating a new financial product. I think it's really important to stress that staking rewards are not yield, and staking is not a financial investment product, right? You are staking your assets, you're staking your Solana, for example, to secure the network and to earn rewards. What we're not trying to do in this industry is create a new financial product. I think what you do have is this broader area of staking, restaking, DeFi, that overall you could classify as a yield area or a yield industry, yield generating industry. That's very interesting overall. You look at things like Bitcoin yield, you look at yields from restaking, and then staking rewards. But it's very important that you differentiate between them. We've worked very hard in this industry to be clear that staking rewards are not yield. And you do have things like DeFi pools, like lending yields, Bitcoin yields. They're very different, but that doesn't make them staking rewards. And it's important that we keep that distinction. In this industry, we do love a generic term for everything, right? We love a bucket that we can throw everything in. And whilst this exactly, and whilst this is a really interesting new area of crypto, staking is not a yield-bearing asset class, and will never will be. But overall, you've got DeFi, you've got Bitcoin lending, and all of these other areas that combined together are unlocking consensus and creating a new revenue stream from consensus mechanisms.
I think the distinction that Ava is making is an important one. That, at the closest to the metal that you can get to categorize it as a yield-bearing sort of financial service is a bad categorization. But I still think it's valid to observe that what emerges from that paradigm is a type of financial service, right? That is yield-bearing. And because you have to remember when you're thinking about staking in the way that Ava is talking about it, you really need to be a part of the consensus mechanism. But a lot of the institutions really aren't. They're just giving their cash over to someone else to perform that service on their behalf. And so to call them a part of the consensus mechanism, I think, is probably a bit of an overstatement. And so I just kind of wanted to bring attention to that fact, that you can still have something that is, by definition, not a yield-bearing financial product, but then, inexorably, the yield-bearing financial products will always emerge from that.
Yeah, I guess to play off both of those points, which I think were very, very valid, I think not the issue that we've had, but when we're fighting against institutions coming in, they are not used to all of these complex terms, right? Like when we're chatting to an institution who is coming over from TradFi who doesn't have a reference point, how do you then explain these products? And the easiest way that people can do that is say, look, it generates yield, and they go, oh, okay. And then their natural, I guess, reference point becomes a fixed income product. And that is, I think, where the things do get misconstrued. And we are still at that level of innovation whereby there isn't this commoditization really that, or some, I guess, gold star or North Star in terms of what it should look like, at which point it becomes easier to say that is what it is, and we can explain that very easily. At the moment, there's a lot of innovation happening at, I guess, protocol level that everyone takes it slightly differently, and that makes the waters a little bit muddied when you're trying to explain things.
People just want to, like, what is it most like? Is it like a dividend? I would say it's most similar to interest on a bank account, right? But everyone wants to say, what financial product is it most like, even if there's not like an exact fit.
And I think, like a lot of things in blockchain, if you got people to use it for its intended use case, meaning that, no, this isn't an interest rate, you actually need to do work. Like the consensus mechanism doesn't do, it's not something that happens automatically. There are people that are, a part of that base substrate that are making sure that the blockchain is appropriately secured. And the reward rate is a type of compensation for performing that work. And then their eyes glaze over, right? Oh, if I have to work for it, I don't really care, right? I just want the staking reward. And I think that that's where you get the same emergent property, right? Similar to the way traditional banking structures operate, where the interest rate is, we're becoming increasingly abstracted in the last few decades, but it used to be that there was, someone who is responsible for distributing funds across yield-bearing loans, and that interest rate was a product of, of those loans. Eventually we ended up in the case where it's like, I don't really care about the loans or how good they are, and you end up with like 2008 sort of financial crisis stuff, which I think is, maybe an appropriate foreshadowing for how staking could go if we continue to treat it as this kind of abstracted, financialization of the security layer of the blockchain.
Any more on that question? No? Okay, so second question is about institutional adoption. What will it take for staking and restaking yields to be recognized by institutions as a standard reportable investment?
So I'll take that. I think we kind of need a degree of liquidity, which I think Wintermute and others are helping provide. We need a degree of, like I said, liquidity. We need some infrastructure which goes behind that, and that includes sort of standardization of these types of yields and understanding of those more broadly to be understood. And I think also the regulatory piece is also pretty key there. I think in sort of sympathy, the three of those actually need to work in conjunction so that you get to a place where institutions feel more comfortable with the standardization of these products. And the debate we've just had sort of emphasizes that. No one really knows what yield means, and putting a sort of definition around that will help regulators. And then once the regulators have a more clear understanding of that, that allows you to build products and infrastructure around it, which is well defined for those parties.
Yeah, regulatory involvement is definitely key. We've seen, continued move towards staking being included in some kind of framework, right? It's on the roadmap for the FCA. We can take examples from, the progress we're seeing in the US, the progress that we've seen in Switzerland with guidelines around staking that is helpful for all market participants. But I think it's important to, again, remember that staking is not an investment, and at no point do we want to get to the stage where an institution thinks that it is, because if you think about it this way, you're staking an asset that you or your underlying clients already hold. Right? We don't often get people calling us up saying, shall I buy ETH, Solana, SWI, Polkadot, and then decide to stake it? Like they have a long-term belief in a protocol, so they're holding the token. They want to support the network, and so they stake it, right? Staking is not the product, the after product. It's part of securing the consensus mechanism, securing the network. So I think that's important to keep in mind. And then the other factor I'd say is data and information on where the rewards are going or have been is really important for financial institutions as they're starting to map out. And maybe Jake can give us his view about how much the data comes into his side of the world when it in respect of staking rewards. But what we see is institutions want to look at where staking has been and is going. So we recently acquired a company called Rated, which looks at a dashboard, an interface for staking rewards across various networks, across various validators, because people want to understand, like, what does that number that I am receiving in rewards mean? Is that good? Is that bad? How does that play to the industry? How will that change over time?
Yeah, I think that's, obviously the regulatory clarity is the main one to allow all of this stuff to go on under the hood, which arguably that has been, but it's not been able to really come to the surface. Liquidity for us is obviously one of the main problems that we try to solve for. That takes a variety of different mediums, but I guess at the very basic level, for us to price anything, we need, as you mentioned, reliable data. We need to understand the risks, and for that it has to be transparent. There has to be an understanding of where the risks lay, which for us, in a staked asset, it's very easy because it's fairly linear in terms of, okay, you've got that and you've got your slashing risk, you know where they can come from. That changes massively with restaked assets because you then are ultimately trying to solve for a known unknown in terms of what the knock-on effects, where's the hidden correlation with all these protocols. You also still have additional contract risk, and it's very difficult to price. And I think for institutions really to come up through, yes, you need the transparency around pricing and liquidity there, which then allows people to come and trade size, and that's ultimately when you get two-way markets, which, I mean, we've seen even things like different scale, but with like Pendle's Boros, and you've seen that coming in and financializing interest rates, and I think that's just increased liquidity in a very different section of the market, but it's a very recent example of how liquidity can lead to adoption in that regard.
I think the question was something along the lines of, like, what's stopping institutions from doing, from adopting these things and reporting them as normal, that kind of thing. And we've actually covered a lot of ground in just what the speakers have said already, and there's two things that I wanted to hop on first. So first, in like direct response to the question, there's nothing stopping it. It's not like anything needs to happen, right? Even when Jake's talking about the regulatory clarity, I would argue that most of the time, that really depends on specifically the financial instrument that you think you're selling. But if you treat crypto the same way that you treat concrete manufacturing, where you have a certain amount of inventory and this is what you expect that you can get on the open market, there really isn't any regulatory concern there. The concern is when you are selling something under the premise that it's likely or guaranteed to go up in value or something like that. Whereas if you take a slightly more pragmatic approach, really most jurisdictions don't have an exception for cryptocurrency, although some do. So there's really nothing stopping it. The liquidity thing that Jake was talking about is something that I've been paying attention to a long time. And be reminded that the title of this panel is the financialization of consensus, which shouldn't be conflated with the tokenization of consensus. These are actually two distinct concepts. You can financialize it already by saying, look, I am a block builder, or I am a searcher, or whatever. And if you help finance my overhead costs, I will share with you some of the proceeds of my effort. That is a financialization of consensus, no problem. And that is very, very distinct from what you have with something like Lido, right? Which says, give us your ETH and we stake your ETH and we share with you the reward rate, and that reward rate is intrinsically tokenized into ST-ETH or WST-ETH, depending on your preference. Now that tokenization component and the liquidity therefrom is extremely problematic, because at the moment, the whole industry has gravitated towards this idea, this assumption that the staked wrapper of the underlying ETH should always trade at parity with the underlying, which is actually foregoing a risk premium that it should have built into it. And a lot of people don't realize this, and we still haven't given the industry a opportunity to even guess at what it's going to look like when, for example, the price of ETH is dropping 25% every 3 days, which is something that we've seen before. The reason I bring this up is that really the staking asset itself, the wrapper, the ST ETH or the Rocket ETH or whatever that you've got, the price that it trades at today should be what the market expects it would be worth at the end of the unstaking queue, right? And so if you can already buy ETH today at whatever ETH's price is, I haven't looked it up recently, let's say it's probably 4-ish K, why would you buy the staked asset now only to be able to unstake it with the risk that it won't be worth 4K tomorrow, right? So there should be a risk premium there where the staked version should actually trade at a heavy discount depending on what the market's risk appetite is. But of course, that's a much more difficult product to market, right? If you want institutional adoption, you say, look, the staking asset is always trading at par with the underlying. There really is no risk. And that's kind of built into these products. And so we don't yet know what the liquidity for these things really looks like because the market hasn't even learned to price in that risk metric. That time delay is significant. It's huge, right? And just recently during the flash crash, we saw the exit queue on ETH went up to like 7 or 8 days or something like that. Like it was impossible for everyone to unstake their stuff. But the price of ST ETH didn't really move off of par too much, right? There was a lot of stuff happening around the flash crash. So of course, you can cherry pick some data for me, but I would argue that across the board, there was weird stuff happening. But that liquidity issue, I think it's valid that Jake brought it up because from an institutional perspective, that matters a lot. But with respect to market fundamentals, it's actually backwards.
Any more to add? Ready to move on? So the next question is about liquidity and market structure. As liquid staking tokens and restaked assets begin trading actively, what would a mature liquid market for staking yield look like? And who will build it? Will it be exchanges, OTC desks, or DeFi protocols?
I guess we've probably answered half the question
I think
already.
so,
I
yeah.
think
But
Mark's already nailed that one.
but I think
Covered
really
2 questions in one a minute ago.
Yeah.
So yeah.
I think really where the innovation is going to happen initially, as it always has done, is decentralized protocols. Like DeFi has led the advent of all these products that we now see as, in our world, they're fairly normal now, they're vanilla. But it all started as a novel concept that then got adopted. Centralized exchanges and obviously custodians have a huge part to play because there has to be somewhere where liquidity is centralized. And whether that can be on DeFi or CeFi, like the pricing models rely on large trades going through those smaller books, arguably. I think where OTC desks then come into the picture are to plug liquidity gaps. I think one of the, I guess, more current examples I can think of is when the staked ETH ETFs were going through the regulatory approval process. A large pushback from the SEC is like, okay, well, there is liquidity risk here because, as you said, like the staked that queue can get exponentially larger, especially if there's a huge market move. No one really knows how to solve for that because we've never seen, I don't know, let's say, the whole of the Ethereum ETF market try and exit at once and it's all staked. That's an unknown. Where OTC desks can then come in is solve for that liquidity gap and say, okay, we can price a forward contract or something equivalent to give. The problem here is that you need instant liquidity for people who are holding this, but we're also pricing an asset that we don't know what the end date might be here. So all of these things need to get to a point where we're happy to trade size there, which for staked ETH, again, like we're talking about this asset, which I guess is fairly vanilla still, and we're still having these problems. When you add restaking and stuff on top of that, and then you get staked, restaked tokens, like then it gets really complex and they're incredibly difficult to sort of price and manage. But I think that's ultimately what the market structure will end up looking like. But you also need like yield curves and ways to look forward. And as you said, like then forward price. Okay, if I'm holding staked ETH and I'm probably going to hold it for XYZ, what's the fair value today? And it should theoretically be easy, but there's a lot of known unknowns basically that go into that process.
It's worth highlighting that the ETH exit queue is currently at 39 days. It was at as much as 42, 43 over the past month. And so, you know, obviously that has put a lot of people on notice of the importance of liquidity, whether they need liquidity or not right now. They're very aware that if they were looking to unstake their ETH, or there was, you know, a huge liquidity issue, another huge liquidity issue in the market, that would impact their ability to unbond, withdraw, and ultimately have the ETH returned to their wallet.
Yeah, I think a lot of the time there needs to be a market event for people to become aware of this stuff. Like, yes, that's a great point. And then you have completely separately, but I think still relevant, like ADLs and things that suddenly everyone's an expert in this week. So it takes an event like the GFC, then everyone knows what a CDO is, like everyone knows how that market works, but it takes something a lot of the time to go wrong before then people become aware of the risks and then can price things a bit better.
Yeah, I'll only add, so there was a sort of footnote at the end of your question there about whether or not it's the responsibility of decentralized systems or centralized systems to sort of shoulder the burden of figuring this out. And I don't think it really matters necessarily. You know, these are different cultural paradigms, and they both pander to different audiences. And that's not to say that one of them is the illegitimate audience, you know, the one's legitimate or something. That's not true. But certain, you know, audience members are constrained, you know, by the rules and regulations of the jurisdictions that they live in. And for many, that has actually been a huge burden, or like, let's say, an insurmountable obstacle to entering like DeFi sort of stuff, and probably explains why the ETFs were as successful as they were, for example. But yeah, I don't think it really matters who sort of steps up to it. I think it's going to, you know, need to be a shared burden across both of those paradigms.
Excellent, thank you. To your point about ETH being backlogged, things like Polkadot is a standard 28-day release before you can even unlock. So yeah, lots of Polkadot holders are used to a big backlog and a long wait to get their coins back. Okay, the next question is about restaking and layered risk. Restaking boosts capital efficiency, but also multiplies exposure across different protocols. How can the industry quantify and price these risks before institutions scale participation?
Yeah, restaking. I'm, you know, I don't want to be sort of Chicken Little about this, but I never really saw the intrinsic value of a restaking thing. For staking in general, right? The idea is that because you have something at stake, right? That you know, that abstracts away the sort of proof of work mechanism, right? You're swapping computational cost for effectively opportunity cost, which makes a lot of sense. With the restaking thing, I think it's really sort of the market getting a little bit carried away with things. And we know that in crypto in particular, there's an enormous appetite for leverage. And really restaking is kind of just an artificial leveraging mechanism on sort of an underlying interest rate, if you like. So yeah, I think that it is building risk into the system. I don't want to say necessarily that it's like, you know, doomsday sort of scenario sort of stuff yet. I'm not convinced that it is. But I do think that it's unnecessarily and uselessly stacking risk onto a system that doesn't really need it.
Yeah, I think like very, very first principles kind of thinking that naturally when you have a higher reward, especially in, I'm not going to call it a financial asset, but the realm of finance, there's always somewhere a risk that you're being compensating for taken, whether that is hidden or known, that always exists. And I think institutions in general do understand that, especially when they're coming in from the traditional landscape, where I guess that's where this large influx of money is likely to come from. In order for them to, I think, feel comfortable with all of these, taking restaking obviously as the main example here, there has to be a way to price each individual risk. So whether that's the additional slashing risk from correlation blowouts, which again, it's a very difficult problem to solve for, whether that's for smart contract risk, or many others that come to the fray, like you need to be able to, I guess, identify, price, and then cover those risks, whether that's through an insurance product similar to CDO or something, but each different tranche needs to be covered. And that's a very different question when you're getting into that layers and layers of like almost hypothecation and hidden leverage, which ultimately at the bare bones, that's what we're talking about.
I think it very much depends on the risk profile of the client in question or the institution in question. You know, a small, nimble asset manager or fund will have a very different risk profile to, you know, a large bank. So I think it depends on how they internally review the risk reward profile of restaking and how comfortable they are internally, kind of technically understanding it and the risks they're exposed to, exactly as you said, you know, whether it be smart contract and so on, or if they feel, hang on, you know, this is something where we don't have the expertise internally to do a full analysis of it yet. And so maybe this doesn't sit well on our risk reward profile. They might make that decision, whereas, you know, we definitely do see other more, say, technically inclined institutions who understand the risks and are comfortable with them. So I think there's definitely a balancing to be done in considering whether restaking is right for an institution and how the risk sits within their internal framework.
And fundamental to that, I think, is just those institutions having access to very granular and qualified data which allows them to interpret that. I think when you think about some of the transactions that are happening in the market, whether it be the S&P trying to standardize its understanding of stablecoins and other ratings agencies of sorts will begin to price those types of risks. And I think, you know, the risk appetite of various institutions will differ, but fundamentally their ability to look into and deeply understand that will be predicated upon those additional data providers.
Yeah, I think like the general point, maybe from all of the comments for the last couple of questions especially, is that there's a lot of nuances that go into these products. And if you're a traditional asset manager who can go and buy the 10-year and yield 4 or 5%, why are you trying to squeeze out an extra 50 bips when you're then looking at a product that you don't fully understand? That's not the incentive that's going to pull people over. The commoditization of it and solid explanations about how these things work that you can really get across very quickly the risks is paramount. And I think, yeah, a lot of this stuff comes back to having the data available, to be honest. If you can have the data, you can price it. That brings liquidity, that brings an understanding, and it all flows down from there.
Okay, right, we're on to the last couple of minutes. So this is kind of a quick fire question, all right? Hypothetically, this is about the road to mainstream adoption. Hypothetically, if 24 and 25 was an experimental phase, what do you think will be the single biggest catalyst that would turn staking into a mainstream yield-bearing market by 2026, just hypothetically?
We're already there.
You think?
Yeah, we're well down that road, right? Turning it into financialization of consensus. You've got Grayscale's staking ETFs. You've got 3iQ. You've got some of the largest banks in the world launching staking products for their clients. You've got asset managers, custodians, everyone you can think of launching staking products. Yes, is there still kind of more development to be had as these products grow and expand? Yes, for sure. But you know, I think we're well down that path. That financialization of consensus is definitely happened. It's just, how does that grow? How does that develop? How do the regulators support the growth? How is it available? Is it just to large institutions, or does it continue to go all the way down to retail who want to access this? Can I, access these products in my pension, in my ISA?
We don't make it easy here, though.
Exactly.
Just with the rules currently on the stocks and shares ISA, they put the ETF in and they're taking it out again within like 3 months' time and putting it in an ISA that nobody uses, for example. So
Exactly. So how far and who can be on this road, I think, is maybe more for the question.
Yeah. I think for me, like to signal that the consensus financialization has really arrived will be not that these institutions are shopping for who to give their ETH to, but they now have a department that actually participates in the consensus layer. And then they offer that to retail clients or their partners or whatever like that. And I think that like this is critical even for just the, let's say the branding of Ethereum, to have Lido's effective monopoly like challenged like very significantly, right? Not to have a few sort of key partners saying, look, we all offer similarized tokenized products, but to have like 100 institutions all participating at the consensus level. I think that that would be really phenomenal.
What about if we could get the Bank of England to run its own ETH validator? That would be a great signal.
That would be amazing.
I'm for it, honestly.
Any more to add? I think that's us then, isn't it? Thanks very much to our panelists for participating this morning.